The United States Central Bank, or the Federal Reserve, the Fed, has officially raised its benchmark interest rate by 75 basis points, BPS. This is the fourth time in a row as part of the phase of fighting a surge in inflation. Thus, the Fed's benchmark interest rate is in the range of 3.75% to 4%, which incidentally is the highest level since early 2008, which marks the sixth time interest rate hike this year. The new policy makes mortgages, consumer loans, and other businesses more expensive and has the potential to increase the risk of a recession. Fed Chair Jerome Powell said in a statement that the Fed may soon move away from the rate hike stage following economic data showing improvement. It said that in the coming months, policymakers will consider the broader impact of interest rates on the economy. Interest rate hikes take time to fully affect growth and inflation, Powell said at a press conference following the policy announcement. Powell himself did not explicitly mention the opportunity for another increase at the meeting in December. However, he stressed that the central bank will continue to take all possible measures, including raising interest rates, in the coming months. As reported by Reuters, a number of analysts assessed that the shift in the Fed's statement to a more dovish direction could have a positive impact on the stock market. Previously, Powell at the last meeting emphasized that he would continue to raise interest rates until inflation subsided. When the latest data shows price increases in Uncle Sam's country are starting to slope, plus the economic rebound in the third quarter of 2.6%, it seems that the Fed is rushing to put the brakes on its aggressive policy a bit. The Fed's far-right statement is a signal of a possible rate cut. It looks like the committee has reached a consensus that they could cut it as early as December, depending on how the data goes, says LH Meyer economist Derek Tang. Meanwhile, economists at Goldman Sachs expect the Fed to still raise their benchmark interest rate to nearly 5% through March next year. The trend of high interest rates can cut consumer spending. However, supply chain disruptions that are starting to subside, so that wage growth and a relatively stable labor market are seen as starting points to reduce inflationary pressures. If inflation continues to slow down, the possibility of lowering interest rates will be wide open.